Good evening everyone. Welcome to this session on dollar INR. Actually not a great evening because the rupee has weakened to a new all-time low. Last week it had declined to 88.33 and this week it has gone up. The dollar has gone up and rupee has plunged to 88.36 and a half. So that is the new all-time low for the rupee. So you can see this is the new all-time low, how it is shown in this 24-hour offshore chart. Okay, obviously the prices have reached an extreme. We had discussed this multiple times. The difference between the moving average and the current price has reached to another high, and the relative strength, the RS, the relative strength of the dollar index to the dollar INR, that is at multi-year or all-time low. Okay, so all suggesting that the rupee is really weak. And what is driving? Earlier the tariff by Trump on Indian exports to US, merchandise exports to US, the tariff was increased to 50%, that pressurized the rupee. Now there are a lot of new rumors coming in that probably Trump will tariff service exports from India to US as well. What was exempted in the previous time, service exports might also be tariffed, and the tariff rates might go higher. So that is additional pressure on the rupee. All of us know that IT services and service exports from India to US is a major contributor of foreign exchange to India, and tariffing or impounding that particular sector is going to create additional problems not only for India but obviously for the exchange rate as well. Okay, so this is that chart. Rupee really weak, the sentiment very nervous. Okay, so let us come to the onshore chart, the dollar INR onshore chart from 9 AM to 3:30 PM India time. Okay, we are aware about these price gaps that had formed in, one formed at 86.75, now one which was formed at 87 got filled up, but another small price gap around 87.28, 29. Okay, and we know from history that price gaps in dollar INR usually fills up. Okay, but now the pressure is on the rupee is so much that there is no downward sign of a movement or a sign to indicate that these price gaps will close. History says that it does close, but here the pressure on rupee is just too much and there are no signs that it will recover to close the gap. Okay, so in these kind of situation, what do I do? Okay, what does exporters and importers do in these kind of situations? Okay, now we had discussed about using vanilla options. Okay, and I had showed in the last session itself that we can look at doing vanilla options for 1 month, 2 months and 3 months. So let's look at this table. This I am looking at a spot of 88.26 and I have a 1 month maturity and the forward rate is 88.37. Okay, 88.37 is the forward rate and I take a dollar call. Okay, in the current situation, importers are the ones that are more nervous. Exporters are anyway benefiting because of a weaker rupee. Sorry. So now importers are the one who are really worried, and they need to look at any kind of a smart hedging solution. So the hedge solution that we propose is to do a vanilla option, and option at what rate? The option at 88.37 half. Okay. So if I take an option at 88.37 half, I pay a option premium of 43 paisa. Now what does that mean? That means that my max rate gets fixed at 88.80 half. Remember, it is the maximum rate that is shown here. So if rupee continues to weaken, I will not pay anything more than 88.80 half. But if rupee gains, okay, so if rupee gains this part of the movement, if rupee gains, then I will be able to participate in that rupee gaining process. But if I do a forward, remember, say this is the forward, if I do a forward, I get the same 88.37 half, and irrespective of whatever happens to the rupee, I get stuck at 88.37 half. So there is no flexibility if I do a forward, but if I do a vanilla option, it gives me a whole lot of flexibility. Okay, let me come to the 2 month period. Okay. So if you look at the 2-month period, at the 2-month period, the forward rate is 88.52. Okay, and I can take a vanilla call at 88.52. You know, ATM call, strike price equal to the forward rate, and I pay an option premium of 60 paisa. Okay, same if I pay an option premium of 60 paisa to a strike price of 88.52, the max rate that I pay is 89.12. Remember again, max rate. So if rupee gains, I participate. If rupee weakens, then I remain to a max level of 89.12. Okay. Similarly, we can do for 3 months as well. If you look at 3 months, the same cost comes to around 72 paisa. Again, my strike price is 88.65 half, which is equal to the forward rate, ATM call. Okay. So at 88.65 half, I pay a max option premium of 72 paisa. Okay. Now this 45, 60, 72 for 1 month, 2 month, 3 month, you might say that it is high. Actually, it is not very high considering the volatility that we have seen. Remember, in the last 1.5 2 months, rupee had weakened from 85.50 to now 88. Okay. So if you are getting some kind of a protection of 1 month at 45 paisa, 2 months at 60 paisa, it is actually not very high. And also remember the kind of chaos that is happening because of the Trump's tariff tantrums. Okay. Now it is creating a lot of volatility. Rupee is under pressure. Actually, it should not be under pressure because the dollar is weak internationally. The DXY is lower, dollar index is lower. But because of the tariff chaos that is happening, rupee is under pressure, and how much pressure it remains in the future, obviously no one has an idea. So importers, we are very strongly suggesting to hedge using vanilla options. You know, it is a fire situation and we need to incur that cost to protect ourselves from further fire. Okay. Exporters anyway are benefiting from a weaker rupee, and if your budgets and targets are much lower, which I am sure it will be, you can do forwards, but you should also look at diversifying into using vanilla puts, so that if rupee does weaken in the future, you get that participation in rupee weakness. Okay. So that is it from my side. To get more such insights on the currency markets, please join our WhatsApp community.